Hello, everybody, and welcome to the UK Mortgage Market Insights for the weekend in the 8th of December 2023. I hope you're all well. In this week's episode, we're going to take a look at the usual lender mortgage rate reductions for this week. We're also going to insert a new section where we look at the lender criteria changes this week. As usual, we're taking a look at the swap rate chart that was updated yesterday evening, and then we're going to move on to the Rightmove House Price Index, the Halifax House Price Index, and the UK finance data. So quite a bit to cover, so let's get straight on with it. So first up this week, let's take a quick look at the lender rate reductions. I'm not going to cover all of them because there's been absolutely loads this week. I'm just going to cover off some of the main ones for you. So we've had the likes of Kensington, Accord Mortgages, Skipton, Bank of Ireland, TSB, Halifax, Santander, Nationwide, and the Mortgage Works, amongst others, all announcing rate reductions this week. And some of them were quite significant, and we're now starting to get some 5-year fixed rates pretty close to the 4% mark. Next, I just want to put in a new section, which is going to cover lender criteria changes. I think this is important because it does show you how lenders are actually adapting to market conditions and trying to make life a little bit easier for more customers. So this week, we've had the following. Aldermore improved their affordability calculations, meaning that there might be the potential for more buy-to-let landlords to be helped. Leeds Building Society have introduced a new mortgage range called the Reach Mortgage Range. Principality and TSB have both improved their stress test calculations. And in particular for TSB, their stress test improvements were aimed at first-time buyers. And then we've had a change in the TSB's interest-only criteria, where they've now introduced the sale of the mortgaged property as one of their repayment methods, which is a great introduction, albeit it does come with some fairly strict conditions. So it's not going to help everybody, but it is going to help some people. So there has been a few lender criteria changes this week, all moving in the right direction to try and help more and more people. So next up, I'd just like to take a quick look at the Rightmove House Price Index. So as you can see on screen, Rightmove has suggested that we've had a better than predicted year because essentially sellers are actually pricing more competitively, which is great news. It does say that average seller asking prices are down by 1.7%, but as Christmas approaches, this is quite typical anyway. Now, it goes on to talk about the transition from the peak that we saw during the pandemic when the market went crazy unexpectedly to what we would normally have as more normal market levels. Now, this year has been a bit slower than it would normally be expected to be, but things do appear to be settling now. It suggests that asking prices are now 3% below the peak that we saw in May of this year, and that sales agreed are now 10% down from what was seen as more normal levels in 2019. Last month, this was actually 15% down, but things have, again, like I said, have started to improve slowly. It also goes on to say about the pandemic stock shortage seems to be improving, but I'm not entirely sure I agree with this. I still think we do have a shortage of properties coming to market in the UK as people put off moving, primarily because of the interest rate hikes that we've seen, and it's having an effect on affordability. But it would also suggest that because the house prices aren't dropping by as much as expected, that stock shortage is actually holding house prices up slightly. So I'm not entirely sure I believe what they're saying about the stock shortage levels. But I've tried to link to the report so you can go take a look at it and have a read for yourselves. So next up, we're going to take a look at the UK Household Finance Review that covers Q3 of 2023. And this really does make bleak reading. It does show what the cost of living crisis has done to the household finances in the UK. Now, I've tried to put this on screen, but I know it's going to be really small. So again, as always, I'm trying to put a link somewhere for you to be able to go take a look at the report yourselves. But let's just take the key findings. It does say that household confidence in Q3 has improved, but it does remain downbeat overall. And it says that in October, confidence really did fall away quite drastically. Retail sales saw a larger than expected contraction, but people were spending more on cards, which is, in my opinion, an indication that they didn't have the cash. So they were using credit to do normal things like day-to-day shopping. It then goes on to say that the contraction in house purchase lending continued. Cost of living pressures and higher interest rates really have muted the mortgage market this year, presenting a real and significant barrier to affordability, which is just having a huge impact, stopping people being able to afford the houses that they want or even to be able to move or purchase in the first place. One thing that we are seeing is people have decided not to remortgage to other lenders, again, because of affordability issues. And instead, what we're seeing is more product transfer transactions, where staying with your existing lender is actually much easier than it is to move lenders. It also goes on to say that households continue to run down their savings. Again, People had savings built up from the pandemic when we just weren't going out and spending money. But now we're starting to see those funds dwindle as the cost of living crisis really does start to take a hold and people are having to spend their hard-earned savings. Arrears have seen a rise in Q3 more than expected, again, because of the impact on the interest rates. And this is a real worrying part of the report because next year there are over 1.4 million people on low fixed rates due to come off those onto higher priced mortgages. So this is going to have an impact on this figure next year, and we could start to see arrears increase even further and repossessions too. So if you've got a mortgage due next year, at the point when you get 6 months away from your fixed rate, please do get in touch with a broker like ourselves so that we can actually take a look at things for you and try to alleviate some of that pain. So now let's take a look at the Halifax House Price Index that came out this week. Key numbers: average house price in the UK, £283,615. House prices apparently went up by 0.5% last month. Over the quarter, they've actually dropped by 0.7%, and annually they are down 1%. Now, if we have a look at that annual figure, being down 1% year on year doesn't actually seem that bad, when last month we were looking at a figure of 3.1% down. And it does say the southeast of England is the place where there is most downward pressure on house prices. Now, all of these different reports that we see, the Nationwide House Price Index and the Halifax House Price Index, all suggesting that prices have gone up. The real important data, as I always say, is going to be the land registry data, because that covers all housing transactions in the UK. The Halifax and the Nationwide indexes only cover their own lending transactions. So they do show you a slightly exaggerated truth on the real picture that's happening in the UK housing market. But just to give you an example of how the Rightmove statements don't quite correlate, the Halifax, they say in their report that UK house prices rose for a second month in a row. And over the last year, despite the economic headwinds that we've been seeing, property prices have held up better than expected, primarily because of the stock shortage. So it's interesting that Rightmove say that we haven't got a stock shortage, yet the Halifax are saying that we have got a stock shortage. I have to say, I will tend to agree more with the Halifax. There is a stock shortage. Transactions are quieter out there, and the estate agents that I speak to are all saying that there just isn't as many properties coming to market. So prices being held up isn't because there is an increased demand from consumers purchasing property. It's because there isn't as much stock, and that's artificially inflating prices because the properties that are there, there's more demand for them, and obviously people are paying more than expected. So that's the only reason that we're seeing prices holding up at the moment. And next, we're going to take a quick look at the swap rate chart that was updated yesterday evening. So that's the most up-to-date one as at the time of recording this video. As you can see, it's great news. If we look at the current column, you can now see that the 5-year swap rate is still on its way down. It has gone below 4%, which is great news. First time it's done that since May this year. If we compare that to exactly 1 year ago, which is the column furthest to the right, although you can see that we're 0.3% higher on the current swap rate than we were at this time last year, it is heading in the right direction. And it was at this time last year when we were starting to see some really good interest rates available from lenders. So this is why we believe that rates are going to continue dropping, and at the start of next year could be really positive for mortgage rates. So it's all really positive news. And this is why we're seeing lenders reducing their rates. Just to clarify to people, because I do get a lot of questions about this, swap rates are the rates that lenders will tend to borrow money at or thereabouts. The lenders will then add their margin onto the rate at which they've borrowed the money, and that is the rate that you see when you're borrowing money from a bank. The swap rates are not the rates at which you can borrow money. So that brings us to the end of this week's episode. As always, thank you for watching, or thank you for listening if you're listening to this on any of the podcast channels. If you aren't yet subscribed to me, then please do subscribe on whichever social media channel you're watching this, so that you can continue to keep these weekly updates dropping into your inbox. And also you can see any daily update videos that we produce, which often cover lender rate reductions amongst criteria changes and other things. Like I said, thank you so much for your support. I really do appreciate it. Just a reminder that every Tuesday and Thursday, we do a live on TikTok from 6:30 to 8:30 p.m. in the evening, where we can answer any burning questions that you've got. So if you're not yet following us on TikTok, please do, please subscribe, and then you will be notified when we go live. But once again, thank you for watching. Have a great weekend, and I'll see you next week. Take care.